So if you think about it just based on the difference in the account that's being affected, I think it becomes pretty straightforward. Well, cash, the change in cash is going to become the, now I'm going to have to go back here. The change in cash becomes this number right here. And it's calculated from the operating, investing, and financing activities. So we exclude the analysis of that, but we calculate it as a double check as we're completing the statement of cash flows. Okay? So I know before I start what this number should be, and I know what this number should be, and I know what this is from last year. So I know the end, and I have to build the rest of it. Oh, and I know net income. I have to build everything in between. Does that help? No.
I meant like prepaid expenses, not as material as accounts.
Oh. Prepaid expenses. Yeah, I understand your thought process there. If your prepaid expenses go up, hang on. If your prepaid expenses go up, did you record the expense? Eric, hang on. Let's think about this. If your prepaid expenses, I'm going to make some prepaid expenses. I'm going to give up, let's see, prepaid rent. Is an asset or a liability? It's an asset. So I'm going to prepay for 6 months worth of rent, $6,000. Okay? What do I have to give up to get that? Cash. What's the effect of net income on that transaction? What? What's my effect on net income? Nothing. I did not affect net income. Did I affect my cash? Yes. I've used up cash. Cash went bye-bye out the door. Did I get an expense for it? No. So when I start with net income, and I'm trying to adjust to the cash method, does my net income reflect the fact that this cash left our company? No. So I have to then look at this and make that adjustment. Say my net income's $45,000, but my cash flow was really 45 minus the 6, so I'm at 39. So you go through each of your transactions and figure it out. Now, the cool thing is, if I prepay this today, I've used up cash. Next year when I use this up, I won't be giving up cash. So when it reverses and I use it up, and my prepaid expenses go down, I actually have more cash than net income. Okay? Does that help? Okay, good. Eric?
What about inventories? Because sometimes you don't pay for cash, you pay
Could you repeat it for me?
inventory.
Inventory. Eric's got a great question here. My inventory, his question I believe is, look, my inventory increased. Okay? So do I know if that's a use of cash or not? What if it's still in accounts payable because I haven't paid for it yet? Well, I'm analyzing accounts payable down here. So you look at the change here and you look at the change down here, and together they have a combined impact on cash. So just look at each one individually and you will come out in the right place. Okay? Don't overcomplicate it. Look at them individually. Figure out which direction it's driving cash. Because later on you add the two together in operating activities anyway, and you're good. Okay? Yes, sir?
They actually cancel each other out, don't they?
If they're the same amount and they do reverse, yes, they will. Okay? If they're not the same amount, and they never are, then there will be a difference. There will be an increase or a decrease in cash because of them. Okay? Anybody else? Okay. Let's jump back forward where we were. Oh, this is where we were, right?
Yes.
Okay. So we've analyzed all the differences after adding back depreciation, and we've determined cash provided by operating activities. For Jim, here's the formula method. Okay? So notice, any of our current assets that increased, subtract from net income, right? They ended up using cash. And if an asset decreased, it actually increases cash. Remember our prepaid rent. When I use up this prepaid rent, my asset decreases, it increases my cash flow. Because I got to use the rent, but I didn't have to give up cash to get it. Okay? And your current liabilities are straightforward. If a liability goes up, you didn't pay for it, so cash didn't leave, it would increase your cash flow. And if your liability decreases, that means you paid out more cash, so you subtract it from cash flow. Okay? Now these two kind of go together, right? Okay. Yes, sir?
Why do they say net income instead of cash?
We know what our ending cash is, but that's not my cash flow for the year. I may have had some at the beginning, right? So I'm trying to figure out if my cash increased or decreased during the year. And if you start with net income, again, it goes back to, if you treat it like it's cash basis, cash in, cash out, that would be cash flow. But because we're doing accrual, we just have to make a few adjustments.
So you're kind of starting at the bottom, they starting at the top.
Yeah, it's one way to look at it. Okay? All right. This is what I call the Thecom Bubble analysis. A lot of bankers or investors will stay away from companies that have great big positive income numbers and negative cash flow year after year after year. What does that imply that they're doing? They're spending way more money than they're bringing in, so they're dependent upon borrowing to stay alive. Okay? And they could be spending it on, property, plant, and equipment. It could be just a growing accounts receivable problem. It could be all kinds of things. But, remember, some of you aren't old enough to remember, but there was, .com bubble burst in 2001. All these internet companies were making tons of profit on paper, but did they have any cash? No. What is cash? Cash is king. If you don't have cash, you're done. So, that's the rule here. Questions on that? You want to know a funny one? I've been doing some stuff on the computer for my Accounting 6 class. And because I'm used to stopping and asking, does anybody have questions? There's no one in the room but me and the computer, and I'm recording this. And I keep going, okay, does anyone have questions? Oh, damn. Okay, new ratio, quality of income ratio. This is how much money, how much of your net income is actually turning into cash. Okay? Cash flow from operations only divided by net income. Calculates the ratio or the portion of income that was generated in cash. So you can have a whole bunch of income, but if you don't have cash coming in, is it doing you any good? No. All right? So, back to our balance sheet. We covered in the last section, this is cash flow from operations. Depreciation, receivables, inventory, prepaid expense, accounts payable, accrued expenses, right? Move forward a little bit. If you start looking at the next section on the cash flow statement, what is that? Cash flows from investing activities. Investing is second, financing is third. What are the investing activities that we see on this balance sheet? Well, they had some short-term investments for starters, right? And we know that they sold those. So cash went which way from that investing activity? Up. Then we have equipment. Property, plant, and equipment went which way? Down. Did we give up cash or get cash here? We should have got cash. So this is your other investing activity. Anybody see any other investing activities on our balance sheet? Hint, just go with the highlighted ones and call it a day. All right. It won't be highlighted on the test though. Yes, ma'am.
What if you sell equipment at a loss?
It's still, that gain or loss shows up in your net income, and then you're modifying it by how much cash you actually got.
Oh yeah, because you have to claim the loss in your...
Right. Okay? So we're gonna go there. Okay, so cash flows from operations, what we covered last time. And then we come down here to cash flows from investing activities, purchases of property, plant, and equipment. Which way did our property, plant, and equipment go?
Down.
Down. However, in total it went down. But notice we, according to this, we bought. They're showing a use here. So you break it up into its component parts. How much money did I spend buying new stuff, and how much money did I get from selling old stuff? So you show the two pieces of it. Okay? Purchases of property, plant, and equipment, and then proceeds. Now, one of the things I love about these slides is, how many errors have we seen? Do these amounts add up to this? No. Okay, so we've got a math problem here somewhere. Let's just go with it for right now. The other thing is, remember we had short-term investments, $3 million, sold it, it's gone. Again, I don't show that as just a $3 million cash flow in. I show that as, here's what I bought, here's what I sold. You show both sides of it. In total, this one works out. That is $3 million. And we're good. Notice if you flow through the math here, 6 million minus the 167 is not 491, and that's an even 3 million. The math totally doesn't work here. Okay, good. I'm not the only one. Okay, so you guys see how those are reported. You need to know both the acquisitions and the dispositions. You report both elements of the transaction separately. Each is its own line item. And you come up with net cash provided by or used by your investing activities. Pretty straightforward, right? Yes, sir.
So first we're going from the balance sheet, we're making calculations. Now we're looking at the cash flow statement. Right?
Well, we're using the balance sheet to analyze the difference, the changes in the accounts between last year and this year. And the changes in those accounts have implications as to what happened to cash. So some of these things are for operating activities, and these two here are for investing activities. And then we've got some financing activities that are going to come up here in a minute. But all three of those are coming out of the balance sheet. Okay, is that what you're trying to?
I think I need to just line them up and look at them and see how they match.
Yeah. Yes, ma'am.
For the proceeds from the disposal of PPD,
Yeah.
where do you get that number from? Because usually on the balance sheet it just has the total, like, PPD, like on that it just has your net equipment number. Like, how do you know how much to take out?
You need to go find out what were the total purchases and what were the total sales.
So you're not going to get that
Just straight off the balance sheet, no. You're going to have to go ask.
Okay.
So there's a little more detail. Okay? Yes?
Are you going to give us something like that on the test, or are you going to give us just a net?
There is a simple one of these on the exam. Hang on. That was too obvious. There might be a simple one of these on the exam. Okay? Okay. Other questions? So where was I? Okay. All right, short-term investments, net cash provided by investing activities. Good. Second ratio of the night, capital acquisition ratio. Cash flow from operating activities divided by cash paid for property, plant, and equipment. Not your total investing activities, just the money that you paid out for property, plant, and equipment. So this tells you if the company's buying new stuff, how much of it can they fund out of current operations? How much are they funding out of current operations? Okay? And this is a good number. This is a good thing. Lenders hate it when you can fund all of your acquisitions out of current operating capital.
So what is the number signify? I mean, like if it's what's considered, let's say, a high.
It's a level of risk. So think about it. If cash flow from operating activities is bigger than the amount that you paid for new equipment, it's a number bigger than 1. You're good. You're gold. Okay? If this ratio becomes very small and you end up with, 1/32 or 1/16 or point, then you're borrowing a lot of money. You're borrowing more money than you bring in from your operations in a year. That scares me as an investor, right? How are you going to pay me back? So, other questions? All right. Have we covered this one yet? Free cash flow? Free cash flow is your cash flow from operating activities, subtract your dividends, subtract your capital expenditures. Okay? Notice it's just cash from operating activities. Everybody good with this one? Yes.
Just a quick question. So it gives the company the ability to pursue long-term investment opportunities?
Right.
Does that mean within its own company, like for plants?
You could buy new equipment, you could buy another company, you could do all kinds of things. But the point is that if I have a large free cash flow number, I've already paid my dividends, I've already paid for my capital expenditures, I've still got cash left over, so I've got positive cash coming into the business even after I cover these things. So I'm growing and I still have a lot of cash, positive cash flow. I'm in good shape. If you're not generating enough cash from operations to cover your dividends, people should stop and take notice real quick. Right? How are you getting the money to pay the dividends? You're borrowing it from somewhere.
I thought the company didn't have to pay dividends.
They don't have to.
So why would you borrow them?
Some do. Some do. One of the homework examples in the book does exactly that. The company loses $200 million and declares a $12 million dividend. Yeah.
Is that maybe just to drive more investors to possibly invest in the company?
So you're borrowing the money to do it. So those situations are something typically like this. Here's a company that's been around for 50 years and it's paid a dividend 50 years in a row. Boom, 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 boom. It's like a money printing machine. All of a sudden, something happens, we have a loss for the first time ever. Do we really want to all of a sudden tell all of our investors we're going to scare everybody off and the price of our stock might dive dramatically? Let's pay the dividend anyway and, we'll turn it around next year, things will be okay. So those kind of decisions do happen. I'm not saying it's the right thing to do, but that was their choice. And there's a logical reason why they did it. Okay? Other questions? Moving right along. So we've done operating activities, investing activities. The last one is financing. What are our financing activities? Contributed capital. That implies we did what? Contributed capital went from 9,158 to 9,803. It went up. It implies we sold some stock. Okay? Stock is an investing activity. It brings money into the company to operate from. So on a cash flow basis, that is a positive, right? Okay. Notice over here they're showing it just as contributed capital. On the next slide there's going to be a treasury stock. Was there treasury stock on our balance sheet? No. Love these slides. So we issued some stock. We bought some stock back and it became treasury stock. In total we have cash provided by financing activities. It happens to be the same amount as this in total. But notice I'm reporting both the ins and the outs here to get to net cash provided by financing activities. Everybody good with that one? It's pretty straightforward, yes? Yes? No?
Can you go over it again, please?
Okay. Contributed capital went up. It implies we sold some stock. Okay? It doesn't show treasury stock here, but when we get over to the next slide, it's showing us, oh, there was some treasury stock. We bought some and brought it into the company. When you buy treasury stock, cash goes where? Out. And then we sold some stock, some new stock. When you sell new stock, cash goes where? In. Cash out, cash in. Net cash provided by financing activities, 645. Okay? Other questions? Okay. So from there, you take your cash provided from financing, your cash used by investing, your cash provided by operating, add them all up, and you get increase or decrease in cash and cash equivalents. Add that to cash at the beginning, you get cash at the end. If it doesn't match the cash on your balance sheet, you have a mistake that you need to go find. Okay? Other questions? All right. So, yes?
The cash and cash equivalents at the beginning of the period, is that the cash from the previous year?
It's the ending cash from last year's balance sheet. Yeah. Okay. So again, the statement of cash flows is a really important document. It can shine the light on a company who's got great positive net income, but that really has made some choices and doesn't have the cash to possibly survive next year or for the next couple of years. Okay, so it's a great tool for investors to look at. It's something that you've got to look at. We learned that the hard way back in, the .com era, and I don't know. Tons of fun. Remember, cash comes from three sources, right? Financing, investing, and operating. Financing is borrowing money or selling stock. Investing is making an investment or selling some asset that you've got. And operating is the business that you're in every day. Okay? We're in the business of being in business, and that's what we do every day. Okay? I'm going to go back. This is your basic statement of cash flows here. Simple, straightforward. There's some other disclosures that are required under GAAP that have to go at the bottom of the statement. Okay, one of them is cash paid for interest and income taxes. You just list that down below. Here's how much cash we paid for interest. Here's how much cash we paid for taxes. Because believe it or not, your tax expense on your income statement may not be how much cash you had to give up. We'll get into that in a whole different class. They also want you to show a reconciliation between net income and the cash flow from operations. Okay? I'm not going to require you to do one on the test, but just so you know it exists. Here's another fun one. They want you to list non-cash investing and financing activities. What might that be? How do you make a non-cash investment?
That'd be like stock for your employees, so you're not actually paying them, but you're giving them the stock options, so they end up owning part of the company.
Is it an investment or a financing activity? Could be a financing activity, yeah. I was thinking more along the lines of we just went out and bought this other company, and we agreed to a purchase price of $1 billion, but we paid them all with our own stock. We didn't spend any cash. We gave them our stock, right? So that's a non-cash investing activity. So that's the kind of disclosure you want to see there. Yes?
Can you explain it a little better? Isn't that what you just did on the cash flow statement? If you reconcile the net income with the cash flow?
Yeah, you're sort of right. And I want to find one and show you because it's probably easier to explain it with an example. So I'll try and pull one out during the break and show you, okay? All right. Other questions? Yes?
What if you assume another company's debt? When you purchase another company and you assume their debt, how would you report that?
It's not going to fall into, it's part of your total purchase price of that company, right? So let's say the company's worth, all of the assets are worth $100,000, but they have $10,000 in debt. So I'm going to pay $90,000 for that company because I'm assuming the debt.
Oh.
All right? So it gets accounted for in that kind of a transaction. All right. Anybody else? Come on. Okay, we can stop.